All right, back for a second show tonight. There was so many requests to cover this. Also, my contacts in the gold and silver industry were bringing me stories. I've heard so many different stories in the last couple weeks. I thought I would give you my 2 cents on this. There is an insane amount of stuff going on in the gold and silver markets. So miners and refiners are voluntarily shutting down for at least 14 days, depending upon which country the mine is located in. Refiners are also shutting down, and this could not have come at a worse time for demand for physical gold and silver. So the paper prices, as you can see there at the top headline, actually, the paper price for gold had its biggest weekly gain since 2008. So up 17%. Silver futures climbed by more than 17% for the week. Gold futures up, rise more than 11-year rebound fueled. Gold futures settled with a loss on Friday, but still scored the biggest weekly rise in more than 11 years in a rebound fueled in part by a weaker dollar and concerns about disruption in the physical market for the precious metal. Volatility for gold is likely to continue in both directions, said Rob Hiworth, senior investment strategist at U.S. Bank Wealth Management. Okay, with central banks ramping up their balance sheets. Also, let me add that many central banks have been enormous net buyers of physical gold now for the last couple years, instead of treasuries that to global financial crisis levels and beyond. Actually, we're past 2008, 2009 levels now for the Federal Reserve, and the other central banks were way past that prior to the Fed. The Fed was actually lagging. The Fed's official balance sheet was lagging the other central banks, and now it has caught up. Or it's in the process of catching up on a percentage of GDP basis. Lynn Alden likes to use central bank balance sheets to GDP percent, and the Fed is catching up. The Fed's balance sheet is catching up very, very quickly. So gold for April delivery on COMEX fell $26.20 or 1.6% today. Settle at $1,625 an ounce. For the week, prices of paper gold, the most active contract, rose 9.5%, which marked the biggest weekly rise since September 2008, according to FactSet. So there was one day, about a 24-hour period, for paper gold futures contracts where there was a $200 price swing. So the price of paper gold in dollars got down to around $1,480, right around there. And then within about 24 hours later, it was at $1,690 or $1,689, something like that. So silver got very, very low. Silver was threatening to potentially bankrupt some of the higher cost silver miners, especially the ones that have already shut down. But now silver has rallied strongly too. The demand for these metals is unbelievable. Many of my podcast listeners have been sharing their stories in the comment section under videos, also messaging me, asking me if I know where I can get them any physical silver without paying $10 an ounce premiums, $12 an ounce premiums, just insane premiums. Good luck trying to get a physical gold 1 ounce gold coin right now at the paper spot price of oh my god, paper spot price is $1,658. Good luck trying to get a 1 ounce gold coin at those prices. Good luck trying to get a 1 ounce silver coin, especially a silver eagle, at anywhere near $14.73. You're not going to find it. I have websites open for APMEX, which is a large bullion dealer. Websites open for SD Bullion. Websites open for Provident Metals. Websites open for Scottsdale Mint. So there's obviously other good bullion dealers, but I just wanted to give you a wide swath here of what the notes are, what they're charging for premiums, if there's delays in shipping. So SD Bullion has a big notice up that at the top of their website saying, please note, due to extremely high order volume, please expect a shipping delay of at least 15 plus business days. There is also a temporary $299 order minimum. Okay, let's go to APMEX. APMEX, I think, still has some delays. They have gotten some back in at higher premiums. A few days ago, APMEX was out, and they had all the alert me buttons for a lot of the silver rounds and silver eagles. The silver eagles that I see there are for pre-sale, and they're selling them for almost $24, and the silver spot price is only $14.73. So it's very, very high premiums. Let me take a look at the silver bars real quick on APMEX. Let's see what the bars are selling for with the premiums on the bars. the bars, oh my god, the bars are like all gone. It's alert me, alert me, alert me, alert me, alert me. There is one 10-ounce bar on here, secondary market, for $197.20 for a 10-ounce bar. So nowhere near spot prices. Alert me, alert me. There's the 100-ounce bars are gone too. So you are not going to get at many of the bullion dealers online or at your local coin stores. Been hearing stories at local coin stores too. There's been local media covering the local coin dealers that they're selling, if they have bullion still, they're selling for much higher premiums, and the lines at some of them were enormously long in the last couple weeks. There was even Democrats there that hate gold and silver and hate guns that were buying physical gold and silver and also in line to buy handguns and shotguns. So the people are reacting to all the craziness that is happening right now. The only way that I've heard from my contacts to get physical silver anywhere near spot prices, and this is to buy a 1,000-ounce bar. So good luck. Most of us can't afford 1,000-ounce bars. I can't afford a 1,000-ounce bar. I know David Morgan did this, I think, in 2008 and 9, the silver guru. So he was buying these enormous silver bars, and through his industry contacts, he was going to the refiners, and he was having these massive silver bars melted down into much smaller bars and rounds. And he was collecting the premiums. He made bank, let's just say. He did very, very well for a short, I don't know exactly how long, but I was a year, give or take, because silver was going nuts from about 2010 to part of 2011. So the bottom line is that getting physical metal anywhere near the paper contracts price is almost impossible. Even if you get a futures contract now, the odds are, if they're going to give you spot price, if they're going to allow you to settle the futures contract, first of all, those assholes are going to keep raising the margin requirements. If you've been in the gold and silver market as long as I have, and I've been following the gold and silver market since 2007, they always cite that they're allowed to raise the margin requirements, and they always give you an excuse about like, oh, it's justified that we're raising the margin requirements, but it's really about that they want to dissuade people as much as possible from taking physical delivery of metal. There were lots of stories in 2011 before silver crashed, when it got as high as $48 an ounce, when it was on its upward trajectory there, going parabolic, that Zero Hedge covered a lot of these stories, and there was a lot of anecdotal stories too, that a lot of people with silver futures contracts who wanted to take delivery were offered 80% cash premiums to not request delivery of the silver. And the COMEX stock warehouses and the COMEX and the LBMA are both having enormous problems sourcing physical metal. It sounds like the rich people have cleaned out, the really, really rich people have cleaned out the COMEX and the LBMA of physical gold, and regular people on Main Street are cleaning out all different sources of physical silver. That the gold contracts are just, I just totally had a brain fart. This is what happens when you try to do 2 live stream shows in like 3 hours. Anyways, the physical metals are just contracting. The demand for physical metals, are exploding. The paper prices, normal games that the bullion banks have played in 2010 and 2011, if you've been around the market, in the gold market, silver market for as long as I have. And we are having bullion banks breaking bad. Say that 3 times fast. So ABN AMRO, which has been in the physical gold business, they've been a bullion bank for 106 years. They are forcing clients to sell. It sounds like they want to get out of the business. We have, the other thing I was going to bring up was that the LBMA and the CME, I think the LBMA specifically, are claiming that they're sourcing refiners in other countries, that they're locating refiners outside of their normal range of refiners. But a lot of the refiners are voluntarily shutting down due to the global pandemic as a precaution. So they're not going to be able to source the physical gold and silver that people think they're going to be able to. But, okay, I just remembered my other point now. I was going to talk about the Jim Poplava story I like to bring up. So COMEX warehouses, LBMA warehouses claim they have a lot of gold and silver on their websites. But I know for a fact, because I spoke to Jim Poplava about this, and he shared this story on the Financial Sense News Hour many, many years ago, that he took physical delivery of a 1-ton silver contract on the COMEX, and clearly the COMEX was supposed to have 1 ton of silver. I mean, they have a lot more than that. At least that's what the paper claims are. And in order to get the silver at the much lower paper price, because the premiums were also going in 2008 and 9 very similar to what they are now. The premiums are actually even higher now. Back then, it was nuts, though, because the silver paper price, I think, was $21 at one point in early 2008. And then by the time Lehman Brothers and AIG happened, the silver price had just crashed enormously. I think the paper price got as low as maybe $8, but the premiums were so high, I don't think anyone could get silver for under like 16. The premiums were almost as much as the paper price. It was like 15 or 16, I think, on eBay and some of the bullion dealers. You were paying an insane amount of premiums. So for Jim Poplava to get the 1 ton of silver at the paper spot price, he should have been able to get the silver basically right away, because COMEX says they have plenty of silver in the warehouse, but in reality it was not true, and it took him over 6 months. And this is while industrial demand at that time for silver was falling, and right now, I think the industrial demand side, the industrial demand side for silver is, I haven't seen any data for industrial demand yet for silver, but my educated guess is that we're going to see a pretty big drop, maybe a total crash in industrial demand for silver that's been accelerating for the last like 3 or 4 months. And probably this is not going to improve on the industrial demand side, but the investment demand side for silver is absolutely exploding, and right now it's probably going to offset that. But the miners here, with the paper price swings, the miners are the ones who are getting killed the most, especially the primary silver miners, because they don't hedge, and it's a moving target for their costs. And what I mean by a moving target, I will explain in an article in depth for my Patreon account contributors. I also have a lot of free lectures on this in my mining stock education playlist. It's on my YouTube channel. You can just, when you go into the search, you can just hit mining stock education. Mining stock lecture series, mining stock education lecture series. It's in there. So there's a lot of stuff on there on maintenance capital and all the input costs. So a lot of people are thinking that the cost for the silver miners is still $15 an ounce, and that because silver was below $15 an ounce for a month or so, for at least a couple weeks, that was going to bankrupt the silver miners for the silver miners' costs, and the oil price did crash, so that's going to help out the silver miners. That's going to allow them to lower costs, but the silver miners are always trying to figure out how to lower costs. So just because in early 2019 the all-in sustaining cost for a lot of the silver miners, they were a lot of them were looking at bankruptcy when the silver price got lower than 15 in early 2019, does not mean that their costs are the same now. So lots of craziness in the gold and silver market. I spoke to someone a couple days ago, and he was trying to source $25,000 worth of physical gold. He was trying to buy some futures contracts or trying to get source. He was calling everyone. He was messaging everyone he could to try to get $25,000 worth of gold for clients, and he couldn't find anywhere near the spot price. But the belief a lot of mainstream people and a lot of mainstream financial professionals and Wall Street people have is that there's a lot of above ground gold, and that the price is, if the price goes high enough, that all this above ground gold, the stocks to flow ratio, that all this above ground gold is going to flood the market and hit the market. Have we seen any evidence that all this above ground gold is going to flood the market and hit the market? I have seen no evidence that the above ground gold, which is in very strong hands, it's in central bank hands, it's in Indian physical, it's in Chinese savers, Indian savers. See no evidence that because the gold price with the premiums is now at $1,800 an ounce or higher, that people are going to collect those $200 premiums. No evidence that people are flooding the market with that. Oh yeah, smash the like button. I have almost 400 people watching and only 56 likes. Edward says, miners are shutting down. Who's going to deliver it to the refiners? The refiners are also shutting down. But this is precautionary. So this might only be for a couple weeks. We'll see. This might only be for 14 days. So let me talk about the margin requirements now. I have stories up about how the paper markets are breaking, gold market is breaking down, gold spreads explode as LBMA warns of liquidity problems and tries to source it from elsewhere. ABN AMRO got in trouble. Longtime Bullion bank. CME urged to change physical gold delivery rules amid market breakdown. See, this is what the Bullion banks do and the exchanges do. When they get in trouble, they just change the rules. This is what happened to the Hunt brothers. I've talked about this a lot. The Hunt brothers got royally screwed. The Hunt brothers were billionaires and still got screwed. So CME Group raised margins for COMEX 100 gold futures contracts by 19.3% on Tuesday, boosting maintenance margins to $8,350 per contract from $7,000. So every time they raise margin requirements, a lot of people can't afford the extra margin hikes. It lets some air out of the balloon. Not saying it's a bubble. I'm saying that they're trying to get some air out of the balloon. But they're scrambling. They're having real problems sourcing metal. And that's because probably the really, really rich people saw what was happening in China with the global pandemic 2 months ago, and they were buying physical gold like crazy. That's probably what was happening. Do I know First Majestic's refiner is still operating? No, but normally they're very high for costs for their silver to buy the retail coins and bars on their website. So I haven't checked their prices, so I don't know offhand, sorry. Okay, got a super chat from Justin. Thank you, Justin. He is also a Patreon account contributor, one of over 600 now. It is growing very rapidly. At least a couple people per day. Want to check out the content for only $5 a month. I think it's a really good deal. There is a lot of well-researched articles there, audio podcasts, and technical analysis charts. I did call the airline stocks and the oil market crashing 2 months ago. And I said it would affect the global supply chain and also cause a lot of other companies like Disney and others problems. There was an extensive article in there about Disney having a lot of problems over a month ago. Okay, thank you for the super chat, Sean. I appreciate it. Okay, let me get to some of these other articles. I have an article here from Reuters from March 25th about the gold margin changes by the CME Group since 2009. So it lists all the different margin changes. As a rule of thumb, the margin changes every time the paper market gets in trouble with not being able to deliver the metal. That's normally when the margin changes. Margin requirements change rapidly. If you were not around in 2011, the amount of margin requirement changes that they did in a 10-day span were insane. They did an insane amount of margin changes in only 10 days. Thank you for the super chat, Charlie. Charlie, what type of books do you want? Charlie asked, can I do book recommendations? He read Richest Man in Babylon and Rich Dad Poor Dad. That's good. You're off to a good start. The Wiley Finance Little Book of Investing series is pretty good. There's a few economics books in there that are not Austrian school economics or Keynesians. Keynesian books, I would stay away from those. But there's a lot of basic investing and finance books in those. And those are easier to understand. There are not that many pages. Peter Schiff also has a beginner's Austrian school book, How an Economy Grows and Why It Crashes. His dad, Erwin Schiff, wrote the original book, and he updated it a little bit. Murray Rothbard's What Has Government Done to Our Money, and also Henry Hazlitt's Economics in One Lesson. That's one of my favorite books. The Mises Institute has a lot of good beginner's books about economics. Kyle, thank you for the super chat. He says, thanks for working so hard, man. Very much appreciate it. You're welcome. Toby asks, thank you for the super chat. Toby, any news on JP Morgan? No, I haven't heard any. But I also don't think JP Morgan doesn't have 300 million ounces of physical silver. I'll tell you what JP Morgan does have. They have a very high commercial mortgage loan book. They are second right behind Wells Fargo. Maybe that's why the Fed is buying everything. Because Wells Fargo and JP Morgan are hemorrhaging cash. Because their commercial real estate mortgage book, loan book, is en fuego. Is now toxic. No, the Hunt brothers got screwed because they owned a ton of physical silver. They were going to open a silver mine, and then the Hunt brothers got greedy, and they bought a ton of silver futures contracts on margin. That was the Hunt brothers' main mistake. The Hunt brothers bought tons and tons of contracts on margin, and the exchanges changed the rules on them. That was their mistake. Had they not played in the futures market, I think the Hunt brothers, and not played with margin, I think the Hunt brothers would have been fine. That was their mistake, their fatal flaw. Because then they got sued, then they got criminal charges, and then there was liquidation. People aren't aware of this because the real story is not in most books. Then there was forced liquidation days. Jim Sinclair has talked about this. He was a trader, Wall Street trader hired by the government to liquidate the Hunt brothers' long positions. The government's basically... The CME group at the time went to the federal government, the Treasury, the Federal Reserve, and got the rules changed and closed down the gold and silver exchanges. And there's also strict position limits on the long side for gold and silver. It is the only futures contracts where there's strict position limits on the long side. The only two. No coincidence. No, it has more to do with the U.S. government and the dollar. Gold and silver are anti-dollar plays. If you're seeing $5,000, $10,000 an ounce gold, if you're seeing $50 silver, $100 silver, $150 silver higher, people are going to start to question the dollar. But as long as the mines are offline, the supply problems, the physical supply problems are only going to get worse. The shortages are only going to be exacerbated. The premiums are going to stay fairly high unless people sell their silver. There was a lot of people, I don't know, 4 or 5 months ago who wanted to dump all their silver. I was getting a lot of messages from people who had given up, wanted to sell all their silver. Whoops. Bet they wish they had it now. Okay, so I will look at listener questions and comments, but that's pretty much all I wanted to say. I think the shortages will get worse. But maybe in a couple weeks or a month, the mines and the refiners will be back online. We'll see. It depends how bad things get with the global pandemic. Right now, the quarantines, the 4 shutdowns are precautionary. There's been very few. I think Vale had 2 employees, and Kinross may have had 1 employee at one of the Russian mines where there was an outbreak. I really haven't heard of any other outbreaks. I heard maybe there was one at a couple people at PDAC in Toronto. I think Lawrence Lepard said that on the interview that I did with him a week or so ago. Jesse says $145 over spot for a gold eagle. Yeah, that's crazy. You can still buy SD Bullion 10-ounce bars, but are only their choice, but you have to wait almost a month before they ship it. Okay, well, this is something that we're going to have to continue to monitor. So if you want to read more about this, I have more of these articles about the margin requirements, the history of the margin requirements, what the CME group is doing. Right now, they're changing the rules to benefit them. The LBMA and the CME group, they're trying to dissuade more people from standing for delivery for the metal. But if people do stand for delivery, they can make you wait months. This is the games they play. They've been doing this for a very long time. They did this all. If you were not around in 2008 and 9, they did this a lot in 2008 and 9. They did this again in 2010 and 11. They play a lot of games on the commodities exchanges, and it's really only with gold and silver. And it's with wait times for delivery for your futures contract, or if there's real shortages, they'll offer you a cash premium to settle so you won't take delivery of the metal. Or they'll claim that the metal's in the warehouse, but then you're waiting 6 months or more to get the metal at the price that you're supposed to get it at. And then they claim that this is a market, that there's price discovery. This is not a market with real price discovery. This is a rigged market where they can change the rules anytime they want. The entities that are hurt the most are the miners, because the price swings in the paper price are so much, the miners, it's a mess for them to try to figure out their costs, to try to figure out their margins. I would not want to be a silver miner right now. It's a disaster for most of the silver miners. Even though silver has rallied, the silver price has been all over the place for a while now. It's got to be an unbelievable headache to be a silver miner, and you think things are really good 2 months ago when silver is much higher, and then it crashes all the way down in a very short amount of time to almost 12, a little over $12 an ounce. And if you're a silver miner, you're like, oh my God, we can't raise any money right now. What are we going to do? And then you have to deal with the global pandemic on top of that. So you can't raise money if you're a silver miner. And then you have the global pandemic. So if you're operating in another country like Peru or another, they might force you to shut down your mine. So you're not getting any cash flow. Do you see all the problems the miners have to deal with? It's an unbelievable headache. And running a mine without all these problems is hard enough. Okay, there's so many things that can go wrong in a mine. And then you have the paper price crashing, and then you have the government, if you're in another country, forcing you to shut down your mine as a precautionary measure for 14 days, and you don't have any cash flow. It's a mess. Okay, last question here are for Thomas before I end this. Jason, do you think the bottom in silver is in? Looks pretty safe now. We have to see the industrial demand component. I think the investment demand for silver is soaring still. But I want to see how bad the industrial demand component is. It's tough to say if the bottom is in. If silver does go lower again, the higher cost silver miners with a lot of debt on their balance sheet, they could not raise capital a couple months ago when silver prices were higher. So the silver miners in 2019 had better margins, and they did benefit from the rally a lot. So they had better margins, they had some free cash flow, they cut their costs a lot over the last couple years. So they did pay back debt, and they did have some more cash on their balance sheet, but they were not able to raise a lot of capital. So the silver miners are just going to, like the higher cost silver miners like Hecla and CDE, if silver goes lower again, those guys are going to be in the most trouble. Okay, well, that's it for this update. The articles will be in the information and description section. I see a million different comments rolling in. A lot of your questions here will be answered behind the paywall with the new article that I'm working on about silver price, the cost of silver, been doing 2 live stream shows tonight, so I probably will have a headache soon, that the cost for silver miners is a moving target. And I'll explain why in more detail in the article. Only $5 a month. You want to take a look behind the paywall on Patreon. I'm not charging a really, really high cost like a lot of other people.